Do you live in a flood-prone area in the US? One major disaster could cost you thousands. Here's what catastrophe insurance can and can't cover. Natural disasters like floods and hurricanes are becoming more common across America. Catastrophe insurance helps protect against major financial losses, but coverage depends on your policy. Flood insurance is often separate from standard homeowners insurance. Today, insurers use AI and advanced risk models to better estimate disaster risks and calculate premiums. Before buying a policy, compare coverage, deductibles, exclusions, and claim limits. Knowing what's covered before disaster strikes can help protect your home, your finances, and your family's future. Follow for more U.S. insurance tips.
This line graph charts the frequency of global natural disasters since 1900. Notice the sharp upward trajectory beginning in 1970. These low-frequency, high-impact events cause massive physical devastation to infrastructure and residential communities. In the United States, catastrophe coverage for this exact type of peril, FIP, is currently operating at a deficit of $19 billion. That shortfall illustrates a core problem. Traditional insurance pricing models struggle to remain actuarial pricing relies on the law of large numbers, using historical expected values to predict future losses. But extreme catastrophic events are rare, meaning there simply isn't enough historical data to map the tail-end risks. Facing this unpredictability, private insurers react by either withdrawing from high-risk markets entirely or offering policies burdened with heavy exclusions. If a house floods, standard policies often exclude temporary living expenses, basement contents, and outdoor property, transferring the financial shock directly to the homeowner. They apply adaptive robust optimization, or ARO, combined with machine learning risk forecasts. Securing financial stability now requires a model that can guarantee solvency against worst-case climate variables, rather than relying on the averages of the past. The baseline deterministic approach formulates a linear program to minimize total premiums collected across multiple locations. To ensure solvency, the model enforces a strict constraint. Total premium revenue, minus projected losses, must exceed a constant mathematical buffer, denoted by delta. However, raising prices reduces participation. The model accounts for this through a behavioral economic constraint called demand damping. This chart illustrates how that demand drop is mathematically defined. It uses a piecewise linear function to keep the optimization problem convex, mapping participation down to a minimum 20% floor as premiums rise. When this deterministic linear program is run on actual NFIP test data from the last decade, using either historical parameters or a cumulative moving average, it results in massive state-level insolvencies, treats future losses not as fixed projections, but as uncertain variables within a mathematically bounded uncertainty set. The first set, UCLT, uses the central limit theorem to bound worst-case deviations from historical loss distributions based on past means and standard deviations. The model's level of conservatism is controlled by a structural parameter called gamma 2. Scaling gamma 2 directly expands the boundaries of the uncertainty set. The larger the parameter, the more the model is forced to price for extreme tail risk scenarios. By deriving the robust counterpart to the original problem, the system ensures that premiums will cover the maximum loss defined within this specific set. But while this first iteration of robust optimization defends against statistically probable shocks from the past, it remains blind to new, emerging climate trends, risk probabilities generated by a machine learning classification model, specifically XGBoost, forecasting the exact likelihood of major flooding events over multi-year horizons. These probabilistic predictions form a second, forward-looking uncertainty set, UML. It bounds future losses strictly by the expected severity of predicted events. Because the total uncertainty set now has two distinct layers, the inner maximization problem is decomposed, solved analytically, and substituted back into the overall convex model. This architecture synthesizes historical statistics with forward-looking artificial intelligence to bound risk from both past deviations and future predictions. Static robust optimization still carries a critical vulnerability. Its parameters are fixed at the beginning of the period and cannot adjust as real-world losses occur. The final architectural evolution is adaptive robust optimization, which deploys affine decision rules to dynamically adjust premiums over time. Under an affine decision rule, the premium is calculated as a linear combination tied directly to the previous year's realized loss. Using an epigraph formulation and strong duality, uncertain terms are shifted into the constraints to maintain a solvable, robust counterpart. These rules allow the pricing mechanism to react to environmental feedback, remaining responsive and equitable year over year. Adaptive robust optimization creates a self-correcting financial engine, continuously adjusting to climate reality without falling victim to rigid forecasting. To evaluate these architectures, researchers tested them against 10 years of out-of-sample NFIP data. The results show that scaling the conservatism parameter gamma 2 systematically drops the number of insolvent states. While all the optimization models easily outperform historical baselines in avoiding insolvency, their relative financial efficiency varies significantly. In an insurance context, efficiency means setting premiums that strictly align with actual risk, rather than simply overcharging to accumulate a massive, unnecessary surplus. Mathematics can guarantee solvency, but the true engineering challenge is achieving that safety while charging the consumer the lowest possible premium. This scatterplot maps the efficient frontier between insolvent states and total surplus. Static baselines, CMA and historical, sit bottom right, representing massive deficit. Static models RO1 and RO2 solve insolvency, but extract inefficient premiums. Adaptive robust optimization achieves the lowest insolvency while charging significantly less. This line graph further shows ARO's tracking accuracy. Even as parameters fluctuate, it produces a stable surplus trajectory that carefully traces the baseline loss levels. By combining machine learning bounds with adaptive decision rules, financial engineers have built a pricing structure capable of navigating the volatile realities of climate change.